Goldman Sachs just told their clients gold is going to $5,000 per ounce by the end of 2026. Bank of America said $7,000. These aren't fringe bloggers. These are institutions managing trillions. They don't throw around numbers like that unless the math is certain. 70 to 85% upside in under 2 years on gold. Here's the problem. Central banks are buying every ounce they can find. And they're not doing it so you can get rich. They're preparing for something that requires them to control the gold supply. And when that moment comes, private ownership becomes inconvenient. History says what happens next. They restrict it, tax it, or take it. April 5th, 1933. Executive Order 6102. Roosevelt makes private gold ownership illegal. Americans have until May 1st to turn in their gold. $20.67 per ounce. Government price, non-negotiable. Refuse, and you face 10 years in prison plus a $10,000 fine. $230,000 in today's money. 3 months later, the government revalues gold to $35 per ounce. 70% increase overnight. But you can't own it anymore. You sold at $20. They repriced at $35. They confiscated your wealth, then made it worth more for themselves. That was 92 years ago. What's happening now rhymes with 1933 in ways that should terrify you. China's central bank added 225 tons in 2023. Reported purchases for 18 consecutive months. Every single month. Buying. India, Poland, Singapore, Turkey, the entire BRICS coalition buying. The World Gold Council reported over 136 tons of central bank purchases in 2022, highest since 1967. Then 2023 matched it. 2024 is tracking higher, but those are just reported purchases. There's a gap. Hundreds of tons per year get bought but don't show up in official data. Unreported official sector purchases. Central banks are buying gold in secret. Why hide it? Because if others knew how much you were accumulating, they'd front run you. So you buy quietly, through intermediaries, through dealers who don't disclose the buyer. You accumulate in darkness, then report later. China did exactly this for years. Radio silence. Then suddenly, we added 600 tons. Surprise. This is preparation for monetary system reconstruction. Goldman and BofA see it in their models. Central bank demand increasing, mine supply constrained. The math says 5 to 7,000. What they're not telling you is why the price goes that high. They're giving you the forecast, not the catalyst. The catalyst is monetary system failure and rebuilding. And in that rebuilding, gold in private hands becomes a problem, so they'll take it, legally, just like 1933. The gilded cage isn't owning gold, it's owning it when they decide you shouldn't. If Goldman is right and gold hits 5,000 by late 2026, that means the dollar's reserve status is failing. Central banks are moving to gold-based settlement, all of which creates the exact conditions where governments historically restrict private ownership. The forecast isn't an opportunity, it's a timeline. You might have 18 months. Then the environment that creates $7,000 gold also creates restrictions. The people who positioned early can exit before restrictions hit. The people who chase the forecast buy right as governments implement controls. They watch the price climb but can't access gains because selling is restricted or taxed into oblivion. Then, once restrictions are in place, the government revalues gold higher, just like 1933. You sold at 4,000 under duress. They mark reserves at 7,000. Today, they don't need physical confiscation. They have digital tracking. Every purchase leaves a record. Every dealer reports to FinCEN. They don't need to find your gold. They just make it illegal to sell, except to them, at their price. The infrastructure already exists. The Patriot Act created extensive financial surveillance. Dealers report transactions over 10,000. Banks flag suspicious activity. The government can freeze accounts, seize assets, restrict transactions. The framework is in place. They just need the crisis that justifies using it. And central banks buying 1,000 plus tons per year while Goldman forecasts $7,000 gold? That's the crisis developing in real time. Goldman doesn't predict $7,000 gold because of inflation. Their models track central bank demand, mine supply, investment flows. One input is overwhelming all others. Official sector purchases. Central banks bought more gold in 2022-2023 than any period since Bretton Woods collapsed in 1971, the last time the global monetary system underwent fundamental restructuring. And look at who's buying. Not Switzerland or Germany, China, India, Poland, Turkey, Singapore. BRICS nations, countries shut out of the dollar system. They're not diversifying, they're exiting the dollar entirely. International trade works like this. Country A wants oil from country B, converts to dollars, sends through SWIFT. Country B receives dollars, converts to their currency. The dollar is the middleman in almost every transaction. This gives the US extraordinary power. In 2022, after Ukraine, the US cut Russian banks from SWIFT, froze dollar assets, seized reserves. Russia still had resources the world needs, but they couldn't trade because they were cut from dollar clearing. Every country watching learned, Dollar reserves aren't really yours. They're yours until the US decides they're not. The alternative? Gold. Gold doesn't route through SWIFT. Can't be frozen remotely. Physical gold in your vault in Beijing belongs to you. Actually, physically yours. This is why BRICS nations are exploring gold-backed trade settlement. Not gold-backed currency, just gold as settlement between central banks. China sells goods to India. India sends gold. No dollars, no SWIFT, no sanctions exposure. For this to work, you need gold, lots of it. Before the transition, because once everyone realizes this is the new system, price explodes. So they're accumulating now, quietly, aggressively. Goldman's model sees central bank buying continuing, BRICS plus expanding, gold settlement mechanisms being tested. If gold becomes settlement for even 20% of international trade, if central banks keep accumulating, price has to reach 5,000 to 7,000 to balance supply and demand. The forecast isn't speculation, it's arithmetic. But here's the tension. For gold-backed trade to be stable, gold prices need stability. Violent swings create chaos. If gold jumps 30% in a month, every contract gets repriced. Central banks need price stability. Private speculators create volatility. In 1968, the London gold pool collapsed for exactly this. Central banks tried holding gold at $35 while private demand surged. Eventually, they ran out of gold to sell. System broke. The lesson? You can't maintain gold-based monetary systems while private markets bid up the price. So when central banks moved to gold settlement, they neutralized private speculation. How? Restrictions on private ownership, taxation, forced exchange into CBDCs at government rates. They don't eliminate private ownership entirely. They just make it illiquid, heavily taxed, disconnected from official monetary price. You can own your gold, you just can't sell easily, can't use for payment, get crushed with taxes if you exit. Meanwhile, central banks trade amongst themselves at official price, which steadily increases as they revalue reserves upward. Two-tier system. Official price for central banks, restricted market for everyone else. Sound familiar? 1933, confiscate at 20. Revalue to 35, 2026, 2027, restrict at 4,000, revalue reserves to 7,000, different mechanism, same outcome. The infrastructure to implement this exists. Defense Production Act allows commandeering private resources during emergencies. International Emergency Economic Powers Act gives authority to regulate transactions. The legal framework is ready. The surveillance infrastructure exists. The precedent was set in 1933. They don't need new laws, just the crisis that justifies the old ones. Let's look at the timeline. 2022, 2024. Accumulation. Central banks buy openly. Prices rise to $2,600, $2,800. Gold still viewed as hedge, not monetary asset. 2025, 2026. Acceleration. BRICS announces gold settlement. More countries join. Goldman and BOFA issue forecasts. Price moves toward $4,000, $5,000. Retail FOMO kicks in. Late 2026, 2027. Crisis. Dollar reserve status deteriorating. Gold hits 5,000 plus. Government announces temporary measures. Restrictions on trading, mandatory reporting, windfall taxes. 2027, 2028. Restructuring. New monetary arrangements announced. Central banks revalue reserves at 7,000 plus. Private holders exchange into CBDCs at controlled rates or hold illiquid gold. This isn't prophecy, this is pattern recognition. The window to benefit is narrowing. If you bought at $1,800, you're up 50%. You can exit with gains before restrictions. If you buy at $3,000, hoping for $7,000, you're buying into the intervention phase. If you buy at $5,000, chasing the forecast, you're buying as the cage closes. You don't wake up to gold ownership illegal headlines. It's incremental. First, enhanced reporting. Dealers report all transactions over $600, framed as anti-money laundering. Second, windfall profits tax. Gold gains above threshold taxed at 70-80%, framed as fairness. Third, strategic resource designation. Gold classified as critical. Sales require approval. Exports banned. Fourth, mandatory exchange program. Exchange into CBDC at government rate. Voluntary, then mandatory. Each step legally defensible. Each step tightens the cage. By the time you realize you're trapped, exit is impossible. For gold to reach 7,000, total market cap approaches $90 trillion, near global GDP. Gold doesn't become that valuable from inflation fears. It becomes that valuable when remonetized, when it becomes the actual settlement layer of international finance. Remonetization requires control. August 15th, 1971. Nixon closes the gold window. Foreign central banks can't exchange dollars for gold anymore. This ends Bretton Woods. Why? Because the US printed more dollars than it had gold to back. France was exchanging dollars for gold, draining Fort Knox. Nixon broke the link. Gold immediately rose. By 1974, $180. By 1980, $850. 24-fold increase. But that wealth went to people who owned gold before the system broke. If you bought after Nixon's announcement, you were chasing. The real winners positioned before the break, when gold was boring, fixed at $35. We're in a similar pre-break moment now. The dollar system is cracking. Central banks are preparing. Gold is being accumulated while relatively cheap. People who understand this are buying at $2,000 or $3,000. People who wait for confirmation will be buying right as governments implement controls. Governments can't allow monetary transitions in free markets. Too much chaos. This time, gold is being remonetized. But the control mechanism will be the same. Restrict during transition, allow limited ownership after the new system is in place. The restrictions won't be temporary bans. They'll be permanent controls creating two-tier systems. Central banks trade freely at official prices. Private citizens face restrictions, heavy taxation, disconnection from official prices. You'll own your gold. You just won't be able to do anything useful with it. Here's what you actually control. You can't stop central banks, can't prevent dollar erosion, can't block restrictions, but you can recognize the pattern, understand the timeline, position ahead of restrictions. Pattern 1. Central bank buying accelerates before transitions. Before Bretton Woods collapsed, they were quietly accumulating while defending the $35 peg. Before 1933, government was accumulating for revaluation. Now, record pace buying, transition is coming. Pattern 2. Major institution forecasts signal endgame. Goldman and Buffett are telling institutional clients the monetary system is changing. Retail thinks it's a buy signal, it's a timeline signal, maybe 2 years before transition accelerates. Pattern 3. Restrictions come gradually, justified by crisis, never announced day one. Reporting, then taxation, then strategic controls, then mandatory exchange. Watch for expanded reporting thresholds. Wealth taxes, including metals, windfall profits, talk, strategic designations, emergency powers. Pattern 4. Two-tier system emerges after restrictions. Central banks revalue higher after private trading restricted. 1933 was 20 to 35. This time, 4,000 to 7,000. If you own gold, exit window narrower than you think. Don't chase 7,000. If gold hits 4,000 and you've doubled, consider profits before restrictions. If buying gold, you're late to accumulation. Your risk isn't market risk, it's regulatory risk. You're buying a position in a monetary transition. Transitions are dangerous for latecomers. If you don't own gold, this transition affects you anyway. When monetary systems restructure, currencies lose value. The wealth transfer happens whether you hold gold or not. Most people don't own physical gold, so why does this matter? Because the forces driving central banks to accumulate are forces that devalue everything denominated in currency. When Goldman says 7,000, they're not saying gold becomes more valuable. They're saying currency becomes less valuable relative to hard assets. Your salary, savings, bonds, retirement, all denominated in currency losing purchasing power. People holding hard assets benefit. People holding currency get quietly crushed. This wealth transfer doesn't happen as dramatic crash, gradual erosion. Salary stays same nominally, buys less. Savings show same number, represents less purchasing power. Meanwhile, asset prices inflate, housing more expensive, stocks up, but so is food, energy, healthcare. You're treading water financially. That's not personal failure. That's monetary debasement. It accelerates during transitions. 50,000 in savings at 2% interest earns 1,000 per year. If real inflation is 6-7%, you're losing 3-4,000 per year in purchasing power. If gold goes from 2,700 to 7,000, 160%. It's not because gold became magical. It's because currency lost value. Your 50,000 lost the same value. Gold didn't make money. Holding currency lost money. This is why central banks are buying. Protection against currency devaluation they know is coming. But if you try doing what central banks do, accumulate gold for protection, you run into the gilded cage. Central banks can buy freely, hold indefinitely, trade at official prices. They control the system. You can buy, but your ability to hold and sell freely may be restricted exactly when you need it. They don't need agents door to door. They have digital surveillance. Every gold purchase creates records. Every storage facility has databases. Every dealer reports to FinCEN. Government already knows who owns what. When they act, executive order, precious metals subject to emergency regulations, register within 90 days, sales restricted to approved buyers at reference prices, exports banned, you get a letter, 90 days to comply. What are you going to do? Refuse? You're a criminal? Hide it? They know you bought it? Sell quickly? To whom? Your only option is compliance. Whatever terms government sets, maybe you still own it, but can't sell freely, can't use as collateral, can't transfer without permission. Frozen asset, technically yours, practically useless. Meanwhile, official monetary price climbs to 7,000. You can't access it. You're locked in restricted private market with artificial limits. For people who don't own gold, you're not safe either. The transition creating $7,000 gold creates chaos for currency-denominated assets. Your mortgage denominated in dollars. If dollar weakens, debt easier to pay nominally. But income might not keep pace. Your bonds denominated in dollars. Currency debasement accelerates, bond yields spike, prices collapse. Your stocks priced in dollars. They might go up nominally, but if it takes $7,000 for an ounce versus $2,700 today, did stocks gain or did the measuring stick shrink? All reference points break. You can't tell if you're richer or if currency is worthless. Account balance up, you feel wealthier. But gas costs twice as much, groceries twice as much. Most people can't do that math real time. They see nominal gains, think they're fine, don't realize purchasing power eroding faster than balance growing. By the time they figure it out, transition complete. Wealth transfer already happened. People positioned in hard assets early preserved wealth. People in cash and bonds got crushed. People who chased gold late got trapped in restrictions. Understanding the pattern matters more than owning the asset. You need to recognize when rules are changing. Right now, rules are changing. Central banks moving toward systems with gold backing. Not full gold standard, too rigid. Gold as settlement between central banks, digital currencies for domestic use. This hybrid solves problems. Hard asset backing for international credibility. Digital currency for domestic control, separates monetary base from payment layer, but requires gold control, which means restrictions on private ownership, and requires currency devaluation to make math work. Everyone holding currency-denominated assets loses purchasing power. Adjustment isn't panic, not selling everything for gold coins, just rational rebalancing based on understanding environment. Heavy in cash and bonds? Consider whether that makes sense in currency debasement. Maybe shift to inflation-protected assets, real assets, productive businesses. Own gold already? Consider exit strategy, price target, policy signals that make you sell. Don't assume you can hold through transition without restrictions. Considering buying gold, you're late to the trade. That doesn't mean don't buy, but be realistic about risks. You're buying regulatory risk with price exposure. Regardless of gold position, the broader transition affects everything you own, your salary worth less. Your debt easier to pay nominally, but harder if income doesn't keep pace. Investments measured in currency losing value. None of this is avoidable. Transition happening whether you prepare or not, but understanding gives time to adjust. Rebalance. Exit dangerous positions. Enter positions preserving wealth. People who get hurt are people who don't see it coming, who keep doing what worked for 20 years without recognizing system change. And people who see Goldman forecast, buy gold at 5,000, get trapped in restrictions they didn't anticipate. Winners recognized pattern early, positioned appropriately, stayed flexible to adapt. Central banks telling you through actions, record purchases, gold settlement discussions, CBDC development, emergency powers legislation. They're preparing for system change. Goldman telling you with $7,000 forecast, not price prediction, signal about transition magnitude. The question is whether you're listening. April 5th, 1933, Executive Order 6102. Goldman forecasting $7,000 gold by late 2026. 93 years apart. Same pattern. Aggressive government gold accumulation, price revaluation, restrictions on private ownership, wealth transfer from citizens to state. The forecast itself is the warning. When Wall Street tells you 7,000, they're telling institutional clients the monetary system is restructuring and gold is becoming monetary infrastructure again. Restructuring requires control. Control means restrictions. Restrictions mean private holders chasing the forecast get trapped at the moment they thought they were getting rich. Central banks buying every ounce because they understand what's coming. Not buying so you can profit, buying so they control the asset when it matters. China 225 tons. India buying, BRICS accumulating, unreported purchases filling supply gaps. This is preparation for reconstruction. When reconstruction happens, gold in private hands becomes inconvenient, not conspiracy. Mechanics. You can't implement capital controls if citizens exit to gold, can't manage inflation if private markets bid up monetary assets, can't restructure debt if wealth flees to hard assets. So they restrict it, tax it, control it. Not confiscation like 1933, but restrictions achieving same goal. Gold becomes illiquid for private holders, right as official price explodes. You own it. You can't access the value. Timeline is visible. 2 years, maybe less. Central bank buying continues. Price moves toward 4,000 or 5,000. Monetary stress becomes obvious. Governments invoke emergency powers. Restrictions begin. Reporting first, then taxation. Strategic controls. Mandatory exchange into digital currencies at government rates. Each step justified by crisis. Each legally defensible. Each tightening the cage. By the time gold hits 7,000 private holders locked out, central banks revalue reserves. Wealth transfer complete. People who positioned early, bought at 1800 or 2000, they had time to exit before restrictions. They won. People who chased the forecast, bought at 4 or 5,000 hoping for 7, walked into the cage thinking it was opportunity. People who held currency-denominated assets through transition, crushed quietly, losing purchasing power while account balances showed meaningless nominal gains. This is what monetary transitions do. Redistribute wealth from people who don't see it coming to people who control the system. Central banks telling you through actions. Goldman through forecasts. History through 1933. Precedent that never went away. You have the information, the timeline, the pattern. What you do determines whether you navigate the transition or get trapped. The screen might show 7,000 in 2026, but if you can't sell because restrictions prevent it, the number is meaningless. And if you're holding dollars while gold prices to 7,000, you're watching purchasing power collapse while account numbers stay comfortingly stable. Either way, the trap closes. The gilded cage is already being built. The door is still open. The question is whether you walk through it or see it for what it is.